Well, good morning, everyone. Welcome to Getting Started with Options. Today, we are going to talk about short put verticals. So if you don't know what short means or a put gets you into, or what verticals are, you're in exactly the right place, because this is a bullish or a bullish to neutral strategy. And if you don't know what bullish or bullish to neutral means, no problem. We're going to cover that today as well. So this is an introductory level class. Over 12 weeks, we discussed 10 different strategies, and the short put vertical is what is on the menu today. We already have a whole pile of people in here, and the chat is going strong. So I'd like to welcome Chad and Jay and Ken and Kevin and What's the Real Deal and Clictician and Bob and the rest of the gang, Janet and Harry and Joanna. So thank you all for being here. I'd also like to thank Mike Fairborn, who's a fellow coach and a friend, for hanging out in the chat. He's very familiar with this strategy. And so if you've got questions, don't hesitate to type them in, because if you've got a question, chances are there's a whole pile of other people with the same or similar question. If you're watching this in the archives, you can type your question in down below. Also know that both Mike and I have a presence on Twitter, now known as X. My handle, Barb Armstrong CS, and Mike's is Mike Fairborn CS. So here's your official invitation to join us there. Okay, let's get through our important information so we can get right down to business. Know that the information here is for general purposes only. We are going to look at several examples today, and know that these aren't to be construed as recommendations to trade any particular stock or strategy, in any particular way. Know that options carry a high level of risk. They're not suitable for all investors. If you want to trade options with Schwab, you have to apply for option trading privileges, and not all will necessarily qualify, or not all will qualify. We also have to manage our risk and understand what we're risking when we place an option trade. And while we look primarily at technical analysis, which is we look at the charts in this class, other approaches, including knowing what's going on in the world, understanding earnings and fundamental analysis, can help provide a more informed perspective. So we're not recommending that technical analysis is your sole means of investment research. Know that all investing involves risk, including the risk of loss. Let me just make sure I didn't miss. Oh, there we go. What we're doing today includes both what we call a short option and a long option. So we're both buying an option and selling an option. And when we sell an option, or a short option, it can be assigned at any time, from the time we place the trade until we close it out. But we don't get to practice that in paperMoney, because a short option will never be assigned early in paperMoney. Can that happen in a live account? It can. Okay. So just be aware of that. We use the paperMoney application on the thinkorswim desktop platform, and it's a brilliant place to learn, to practice a strategy over and over and over again before you consider placing a trade in your live account. It also is a way to become familiar with this platform, where if you mess it up and put it in the wrong way, no harm, no foul. It's not going to cost you real money. And when we put in a target or a stop loss order, it doesn't guarantee that we're going to get out at exactly that price. Now, when we take a look at this entire series as an overview, the goal is, at the end of it, for you to be able to make an informed decision on whether or not options might be an appropriate thing for you to consider. The other thing that it really does is, it helps you, it gives you an overview. Sorry, I have imposter up there because I posted something on Twitter, and I'm going to share that with you in a minute. But when we take a look at this, if you're starting out and you have a small account, you might say, well, you know what? I know that these covered calls isn't going to work. That strategy isn't going to work for me, because it means I have to own 100 shares. And I don't have enough money in my account to own 100 shares of most things. And so this one won't work for that reason, and neither will this one. But, I really like the idea, and this is what we're talking about today, of these credit spreads, or these debit spreads, or maybe these, long calls and puts. And of these three that are applicable for my, more applicable perhaps for my account size, I think, I'm going to start with these credit spreads first, or with the debit spreads, or whatever it is. So at the end of the 12 weeks, the idea is that you have an idea of which strategy you want to try and develop some mastery in first. The idea isn't that you go, okay, I now know how to trade 10 different strategies and I'm off to the races. So just to clarify, but it gives you a good overview of the lot. And many people have been through this whole rotation multiple times. And every time you go through, you're going to come through with more knowledge, and so you'll pick up more. In the beginning, it can be a bit like drinking out of a fire hose. So if you're here for the first time, please type a greeting into the chat so that we can welcome you, and know that we link arms here every Tuesday at high noon, and we're figuring this out together. So specifically for today, what we're going to look at is something called a short put vertical. And we're going to look at, what this strategy is. What does it even mean? What am I getting myself into if I trade a short put vertical? And why might I consider this to be a strategy I'd be interested in? So we're going to go over some of the basics. We're going to look at when you might want to place a trade. So these are components of a trading plan, right? And I like to cover those in every single class. So it's kind of what to buy or what to sell, when to sell it, how much to sell, and then when to exit. So we're going to cover those four components with respect to this strategy today. And then we're going to look at some example trades. And I'm going to tell you, I went through the stocks on the NASDAQ because I get asked this a lot. How do I find the examples that I do? And so we're going to look at a couple of examples that could work, and then we're going to look at some that we're going, it breaks this rule, or it doesn't meet that requirement, because it's as important to know what to trade, or it's as important to know when to say no as it is kind of when to say yes. Yeah. And so Mitchell's saying, I'm a rookie and I'm learning the basics, and great, you're in exactly the right place. Okay. So let me wipe this out and go on. Now, you may wonder if this is a mistake. It's not. I threw this in here this morning because I'm a visual person, and I know some people learn by hearing, some people learn by doing, some people learn by seeing. So this is for those of you who learn by seeing. And this is what I had to do to make sense of it in the beginning. So you have a stock that's been uptrending, and then it pulls back for a few days, and it starts to go up again, and then it pulls back for a few days, and it starts to go up again, and you're going, I think this is going to continue to go up. And so what I am going to do is I am going to come here below this recent low, and I am going to sell a put. And when I sell a put, what am I agreeing to do? When I sell a put, I am obligating myself. If this goes against me, I can't go, just kidding, I didn't really want to do that. Yeah. When you sell a put, you are agreeing to buy the stock at this price at any time between now and the expiration date. And so let's say that at this time, the stock is at 50. It's trading at 50, and you come in here and you sell this put at 48. Now, how much are you risking? Well, one put represents 100 shares. So you're saying, I'm willing to buy 100 shares of this stock, and if I had to buy it, that would be $4,800. And so if you're saying, well, I don't want to risk being the proud owner of this stock for $4,800, I really just want to be able to make some money. And if you sell this put at 48, let's say you get paid $2 for it. So to protect ourselves to the downside, and our risk is 4,800, because what if the stock went all the way to zero? Now, it may not be likely to go all the way to zero, that would be like an oh, but technically that's what your risk would be, is if the stock were put to you and went to zero. So to define your risk, you buy a put. And what does it mean when you buy a put? When you buy a put, it gives you the right to sell. And so you're going to say, okay, well, I'm going to buy this put at 46. Maybe that cost me $1.50. So the net of it is I end up with 50 cents or $50 a contract. And now my risk is no longer, from 48 to zero. It's no longer $48 a share. Now my risk is the difference between the two strikes, this $2, less what I got paid to get in. So now my risk is, it's gone from $4,800 down to $150. And so, especially if you have a smaller account, or you want to, you're more interested in trades where the risk is more manageable, you might say, well, this looks way more interesting to me than having this kind of risk on the table. Okay. So, and so we could use this if a stock is uptrending. Now, when else might we consider it? Well, what if a stock was going in a big sideways range like this, up and down? Well, when it comes down here and looks like it's going up again, this line here we call support, and this line up here we call resistance. And so if something is bouncing off a support level, could we come back and say, you know what, I think this might be a good opportunity to do that whole like short put vertical thing where I sell a put and buy a put. And as long as it stays above my short strike, I'm good to go. And so for some, depending on where you put your strikes, this is considered to be a higher probability trade, lower return, but higher probability. Another time somebody might consider this is if something comes, let's say it comes back up according to plan and then comes down and then it breaks through resistance. So it's kind of breaking through the ceiling. Then where might a trader, and then let's say it's come back here and it's bounced. So then a trader might say, hey, you know what? I could now do my short put vertical here. Okay, so this is the concept. So it's a bullish, so this is bullish, uptrending, meaning uptrending. And I do my very best to speak in English, but there is a language around trading. And so bullish is uptrending, or if it's going sideways, we can take advantage of that as well. Okay, everybody with me? I don't see any questions. Yeah, okay. So now let's go through a couple of these official slides. So what is this short put vertical? So this is kind of a review of what we've now just talked about. So we're looking at a put option, which is a contract, and when we sell it, we're obligated to buy. So we're going to look at the short strike, or the strike we've sold. Short means sell. So we're going to look at that strike, and we know that we're obligated. If somebody puts the stock to us, we've now bought it. Okay. And we have the right, when we buy, we have the right to sell. So if the stock got put to us at 50, and we would have the right, in the little example I just did, to sell it at 48. So I'm out by $2 less the credit I got when I got in, but at least it's not going to blow up my account. Okay, so the short put vertical, is created by doing one of each of these. We're both selling and buying a less expensive put with the same expiration date, and we end up with a credit. And so it's called a short put vertical because we're selling a put. And the put we're selling is worth more than the put we're buying. So it's a net selling, and we get paid to get in. So we receive a credit. And actually, the most we can make on this trade is what we get paid to get into the trade in the first place. Now, some people will call this a bull put spread because we're doing a spread. We're both buying and selling, and it's net bullish or neutral, a bull put spread. And some people will call this a credit spread. Now, I didn't come up with all these different names. I don't shoot the messenger, because I've started a class and somebody said, oh, I thought we were talking credit spreads today. Well, we are. It's called, this particular credit spread is called a short put vertical. Yeah, so it can go by various names. Okay, so there we go. Now, how much can we make? The most we can make is the credit that we, the credit we receive when we open the trade, like I just said. So that's our max gain. And how much can we lose is the difference between the strikes minus the credit. And so a lot of traders will position size, or at least some, may position size based on max loss to be conservative. And in our example today, and in our trading a smaller account class, which I teach Mondays and Fridays, we position size based on max loss. Are we expecting to take a max loss? We are not. But are we planning for it just in case? Yes. So, and some traders, if they're creating an example trading plan, they want to be aware of upcoming events, and they may say, I'm not going to trade this over earnings because I've seen stocks gap up and gap down over earnings. And if it gaps down, then I'm like right away at max loss. And that would suck. And yeah, it would. So if you want to avoid that volatility, now others might say, but volatility is higher, so this is a good time to create a short put vertical. And so some traders will trade this over earnings for that reason. And it just depends on how strong the lining of your stomach is and how confident you are in a particular stock and all of that. But one of our guidelines for this, if you're using it as an ongoing wash, rinse, repeat, trying as a growth strategy or an income generating strategy, you might have a rule in there saying, yeah, we don't trade this over earnings. So, and you can go either way, and there's no one right or one wrong answer. This would be your trading plan, and you have to decide, what components you want in it. Okay. So what are the benefits? Well, some will use it to generate income in their portfolio. They might have a bunch of stocks that they want to own longer term, or other investments, but they're looking for something that they can do that would generate income, on a weekly or a monthly basis. And so they might say, what, I think this strategy might be a good one. Others might say, I don't need the money, I just want to continue to grow the account. And so this credit, it is a credit spread. It creates a lower break even than just buying the stock. Okay. But the gains are limited. The most you can make is the credit that you get when you get in. And our time frame, it's a short to intermediate time frame, generally speaking, looking 20 to 50 days. And often in our examples, we tend to skew closer to the 20 than the 50. Now, what's the advantage of being closer to 20 is your time decay is going to kick in faster, because as you approach, if my hand is the expiration date, as you approach expiration, time decay accelerates. So it's like a block of ice coming close to the fireplace. It starts melting faster. At 50 days, you'll get more premium, but you're going to be in the trade longer. So some people might look at it and say, I'd rather do 2 25-day trades than 150. And that's something you have to kind of look at your numbers and go from there. So our max risk, again, the difference between the strikes, they say repetition's the mother of all learning, right? Minus the credit. And then there can be commissions or transaction fees on top of that, which can kind of detract from your gains or kind of add salt to the wound if it's not a profitable trade. But know that short options can be assigned at any time. And then you have to decide what you're going to do if that stock is assigned to you. And then you got to keep in mind that if you take a max loss, and our thing was we could make 50 and we could lose $1.50 or $150. So one max loss can wipe out, 3 max gains. Boom, just like that. So you've got to manage these, okay? And for some people, I've talked to some people that actively trade and they say, I don't like that risk reward ratio. And that's fair. So now if we come to our trading plan, because I want to get out to the platform, this first page is what? This is the, there's what, when, how much, and when do we exit. So this would be our, what to sell. Okay, so what are we looking for? Well, we are looking for stocks that are uptrending. And some might also say, well, if I'm going to pull this particular strategy out of my kit bag or my toolbox of trading strategies, I don't want to see just that the stock is bullish. I'd love to see that this sector is bullish. And I'd like to see that the overall market is bullish. So then they might look at the S&P 500. They might look at, if it's a tech stock at that sector and say, hey, is this one swimming against the current, or am I trying to go with the flow of the whole market? So you want a stock that's bullish, ideally in a sector that's bullish, in a market that's bullish. And then we want stocks that have high trading volumes, and you might have as your rule, you want it to be 1 million shares a day or more. Now, others might say 5 million, and others might say, I don't even care how many shares the stock trades as long as the options have high trading volume. But if you look for a stock with high trading volume, you're more likely to have options that have higher trading volumes. And on the option chain, that's expressed as open interest, the number of contracts that were on the books when the market opened today, and volume is the number of contracts that have exchanged hands today. And why do you care about that? Well, you want liquidity. You don't want it to be just you and the market maker duking it out, because I can guarantee you, he or she has more experience than you and I put together probably. And you're not going to come out ahead on that exchange. And how do we know, how much the market maker is getting out of it? Well, they get the difference between the bid price and the ask price. And so we want that to be tight. And if it's heavily traded, then it's more likely that the market maker is willing to take a little less. And so, you might say here for higher trading volumes, you might say, I want this to be 20 times the number of contracts I'm going to trade. I know some coaches don't even put this on their option chain. They're just looking for the bid-ask spread to be okay. And as long as that's less than 10%, they're good to go. If it's more than 10% wide, they might be saying, well, I probably don't have the trading volume. So these are just ideas, okay? These are just ideas. So given that we have these ideas, so we're going to tuck that in, the back of our mind. I used to create a checklist, nerd on steroids, I admit it. Because I didn't want to miss something. So I'd create a checklist, like, is the market up trending? Yes. Is the sector up trending? Yes. Check, check, check. Does it have volume? Check. And then I'd come in and look at entry. And so this is the when to sell a put vertical. So we did the what, here's the when. And I've already covered these, so we're not going to spend much time on this. We're looking if something is in a sideways range, right? We want to get it when it is, let me change my color here. But when it's bouncing off a support level, or when it's breaking above resistance, or, and we don't really have this on the chart, when we have this uptrend and we're looking for a close. This is a what they call a bull flag pattern. So this is another, and these aren't all the entries, but these are some of the potential entries on a stock that's uptrending. A close above the high of the low day, and they call that a hold. So just to throw one more term at you, okay? And then where do we want to sell our strike? We want to sell it below recent support. So that might be here. Old resistance often becomes new support. So here or below here. Okay, so let's go out and see what we can find. Because this is where it kind of becomes real to me. Like the rest is all, you know, we're talking about what's possible, but now it's like, show me something in the market today. So if we come out and we look at Netflix, we can see that this stock has been uptrending. Well, how can we see that? Well, one, if we just, okay, let me erase that. We just come and we look up here. Year to date, this stock is up 40%. You know, we can see it's been uptrending, and then it kind of consolidated for a bit, didn't it? And this is kind of one of these, now it has broken above resistance, and often old ceilings become new floors. So could we come and sell something below this 654? Maybe sell a 650 and a 645. So we'd be selling this put and buying this put. And we want to be below this support level. Now it's already at 681. We're looking to sell something that's, you know, $30 below. So, you know, it gives us some wiggle room, right? Right. Okay, so let's go look at the trade tab. So I'm going to erase that. So we're going to come to the trade tab. And what were the things on our what to buy recipe? It was, does it trade 1 million shares a day or more? Well, yep, check. We want it to be 20 to 50 days. So we've got 24 here. This is a weekly in purple. So it's likely to have less volume. You can see here, we have 1,200 contracts. You know, we've got, actually we're going to be on the put side. So we're not really looking at this side. This is the calls. We're over here on the put side. But, you know, if we look at, and where did we want to be? Didn't we want to be at 650? So we have to add some more strikes to this. So let me go. I have to erase this. Yeah, we want it to be at 650. So we're going to add another 10 strikes, and that's how we adjust it. So if I come here to 650, then the question is, do we have 20 times the number of contracts? We do. We have 178. How many of these are we going to do? Probably just one or two. And do we have a tight bid-ask spread? Is the difference between the bid and the ask less than 10%? Well, it's about, 20 cents. So we're good there. And on the 645, it's 25. So that's about 5%. Now, I added this probability in the money column. And if you don't have that on yours, you can come and just customize it. So I have created something called Barb's Basics with probability in the money. And so you just come to customize, and then you start typing in probability, and you can add that. Okay, so I already put it on here. But what this means is if I come to this 650 strike, we've got a 24% probability of this being in the money, which means you've got a 75% probability of this expiring worthless. Okay, there's a question, how did I calculate that 10%? I just said, okay, at the 650, let's say that this is $6, then I'd have 60 cents worth of wiggle room. And, you know, I want it to be less than 60 cents between the bid and the ask, and it's 40 cents. So that's acceptable. Okay, so, and somebody's saying, would you not rather come out to the monthlies? Well, let's look at this, and then we can do that. So let's look at 650. And we are looking to sell a vertical, and it will automatically populate the next closest one. So what are we risking here? We're risking $4 to make $1. That's a potential 25% return on our risk. And we're going to be in the trade no more than 24 days. Okay. So if we look at that and say, well, that's not too bad. Now, somebody said, what if we come out for another week and we come out to this July 19th? So instead of being out in 24 days, we're in 31 days, and we can see we have, more volume here. Now, the bid-ask spread isn't any tighter. It's still about 60. In fact, it's 60 cents. And then someone asked me in a survey yesterday, can you talk about when I might want to use a vertical instead of just buying the put or selling the put? Well, if you sell the put, and the stock is put to you, you now have a $65,000 position. If you have a small account, you can't afford to take that risk. Also, to just sell the put, these are expensive. And so, although you'd be receiving this premium, you might end up, having to buy $65,000 worth of stock. Okay, so yeah, my kind of rule of thumb, or an example rule of thumb, is you want to get at least 1% a day. So if I change this to July 19th, I'm now getting $1.50. So how much am I now risking? So if this is $1.70 divided by 320, now that's a 53% return on risk potentially. And I'm in the trade a week longer. What's one of the benefits is that there are more contracts. Not a ton more. This is 178 and 98. This is a very heavily traded stock. And this is 534 and 385. Well, so it is more. So if we come out to July and we do this for 170, we're risking 320. If we were in our smaller account, how many of these could we do? We could only do one because we don't want to risk more than $500. And we might say, hey, when I've got 80% of my max gain, I would like to buy this back and take my risk off the table. And so if we come down here to advanced order, where it says single order, we're going to make that a first trigger sequence. We're going to right click and create an opposite order. And I'm just going to take 17 and multiply it by 2. So that gives me 34. So that means, okay, well now 30, if it's at $1.50. This means that if I pay 30 cents to buy it back, I've got 80% of the max gain. And so if we put that in at 30, good till canceled, and then we come to confirm and send, we're at 650. We're selling a put vertical for 650 and 645 for 157. And we want to buy it back when we've got about 80% of our max gain. Our max profit on this is the 157 were it to expire worthless. And our max loss, if we close it out prior to expiration, is $343. 1% per day refers to, if I take this here, the most I can make is 157, and the most I can lose is 343. If I divide this into this, let me put this in. I don't have a short put vertical group created in this account, so we're just going to go ahead and send that in. If I take that 157 divided by, what was it, 353, 347? I forget what it was now. Let's say it was 150 divided by 350, just to make the math. It's the point we're trying to make, divided by 350. So this is a potential return of 42.8% for a trade we would be in for 31 days. So some traders might have, as part of their trading plan, a rule of thumb that, this is that you want to get at least a 31% return on your risk if you're going to place the trade. And if you can't, then you don't place the trade. And then if I can make $1.50, that's my max gain. If I multiply that by 0.2, that's 30 cents. Well, that means I've got 80% of my max gain. So that's how I calculate that. Or I could, if you wanted, you could take, okay, I'm being paid $1.50 to get in. I'm going to multiply that by 0.8. That's $1.20. And then I'm going to subtract that from $1.50. Either way, I get to 30 cents. Okay. Okay. So I want to show you a couple of other examples just before we go. And what I did is I just started clicking through. I linked my NASDAQ to the chart. I linked my watch list to the chart. So when I come and look at ADP, this has been going sideways for a long time, hasn't it? And it just recently bounced yesterday off this support level. So could we come out and sell the 240 and come out, say, to this same July? So here, the 240, you've got only $10 wide spreads. So we could look at that and say, okay, well, we're okay with that. Sell a vertical. I'm getting $1.55 on this, but when I look at that, that's on $10. So I'm getting $1.55, and we're dividing that by 8.45. That's 18%. What do we want? We want 30. So is that going to float our boat? If we have that as part of our trading plan, and in the last week, I cover this, kind of the 7 rules or 7 things I wish I'd known. 18% doesn't meet our guideline of 31. So if it doesn't follow our rule, are we going to break it? We are not. We're just going to say, there are other fish in the sea. So away we go. So there's one. Yeah, but no. How about Amgen? So, sometimes the setup looks great, and this setup looked great, but it didn't meet some of our other rules. How about Amgen? Well, it came down. It's only up 6% year to date. So the S&P is up a lot more than that, and so is the NASDAQ, but it's kind of come and bounced off this support level. Could we maybe sell something here at around 295? And if you come to the trade tab, it probably trades more than 1 million shares a day, so that's okay. But if we come out to July and we said we wanted to be below 290, 295. Well, when we look at this, and it's interesting because when I looked at this earlier, the spreads were really wide, and now they're much closer. And we've got about a 70% chance of this expiring worthless. So is this a possibility? Yeah, it could be. The risk on these is always going to be greater than the reward, or most of the time. So you could look at that and say, okay, well, that one has a potential. And we're only going to put this one in, the one that we did. How about CMCSA? Now, this has found a support level, hasn't it? And it's come down here before. But what are we looking for? Remember our guideline for the stock? We want it to be uptrending. Is this uptrending? It's not. So is it up year to date? No, it's not. And so we'd eliminate this because it's actually downtrending, and today's candle isn't indicating that it's done falling yet. And so you might look at this and say, it's at a support level. Yeah, but there's no sign that it's necessarily bouncing, and this is overall a downtrend still. So that one would be off the list. Okay, and then let's look at Microsoft. So with Microsoft, this, it's up 18% year to date. It's been uptrending. If we look at it, it kind of consolidated, right? And we had this ceiling here, 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 and then what happened? It broke out. But what candle are we getting today? We're getting this candle that might indicate, it might, and we don't know for sure, but it might come back and retest this support level and then take off. Now, tomorrow it could end up just taking off, or it could come all the way back in here. We don't know. But if it were to come back and then bounce, we might, where do we want to put our strikes? We'd want to put them below here. And if it looks like it may be pulling back, we may just want to be patient. I know that patience isn't necessarily my strong suit either, but that may be something you want to consider. Now, if we look at Meta, let's look at just one or two others. And Meta is another one. Where has this stock been uptrending? Well, if we look here, it's up 40% year to date. So yes, it's been uptrending. And then it kind of consolidated, took a hit on earnings, and is now, floor, 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 ceiling, ceiling, and then it broke out again. So, could we look at that and say, could we sell something here below the 480? Now, when I looked at this a little earlier, it was still showing a green candle. So may we just want to wait and be patient? Yes. And knowing, when to just sit on your hands and wait and put it on a watch list and just keep checking it daily is not a bad idea. And then here's another example that's breaking out. So could we sell something down here below this 97? And so if you wanted to practice, in your paperMoney account, could this be a place where you might want to practice? And could the previous one we looked at on Meta be one where you're saying, I'm going to wait until I practice, because I'm going to practice as if this were in my account. Now, just quickly, because somebody has asked, what happens if it goes awry? Well, let's say we had placed this trade and then the stock goes down below both strikes, and it's not even expiration, and we're assigned this stock at 95. Well, and let's say it's down here trading at 85. Well, we have the right, because we've bought a put, to sell it at 93. And so if this goes against us and it's put to us, we can just turn around and sell it for 93. Now we've got our max loss. That's $2 a share. And let's say we got paid 50 cents to get in. So we'd be down that $150. But at least we've defined our risk. Okay. Now, what if we had sold something here and it comes down in between and we're assigned, and so we have to buy this stock at, let's say 75, and we have a strike at 73 and it's trading at 74. Well, if we're assigned at 75 and we now have 100 shares of stock, we can just turn around and sell it at 74. And then if the stock keeps falling, we still have this put that we bought. So we're down $1 minus the 50 cents we got paid to get in. So we're down $50. Okay, here we're down 150. But if the stock continues to fall, this put that we bought is going to go up in value. We could still end up with a profitable trade. Okay, so guys, I am out of time. I love all your questions. I love that you're thinking about this. This is all a really great sign. If you want to know more about short puts, there is a class dedicated to short put verticals and its companion strategy, the short call vertical, taught by Ken Rose on Wednesdays. So you could immerse yourself in this every Wednesday and just develop some expertise, because Ken talks about nothing but short verticals every Wednesday. I think it's at noon Eastern. And so, we want to consider, our short strike. We often want that to be below as many support levels as we can get it. The expiration date between 20 and 50 days. We might have that minimum return on risk requirement as part of our trading plan. But as some traders might position size based on max loss, and we tend to overall be bullish or looking for something that's going sideways. Okay. And when to get out, 4 to 10 days prior to expiration. Some might have that guideline. Certainly prior to expiration, because if it expires in between the strikes and then the price gaps down over the weekend, you could lose more than your a theoretical max loss. So if you get out prior to expiration, then you can avoid that. And Ken talks more about these in his classes. Like if it breaks a major support level, you may decide to just wasn't what you were expecting, so decide to get out. So as we close, I think we've covered what we set out to cover today. I ask that you hit the like button. It helps more people find this content, and it lets Mike and I know that you found this valuable. So hit the like button, hit the subscribe button if you haven't subscribed already. Make sure you follow us in the land of Twitter, but know that neither Mike nor I will ever reach out to you, offer to trade your account on your behalf, offer you a Bitcoin deal or a crypto deal or private education. Those are thieves and scammers. Please don't get taken in. And that's a wrap, guys. I thank you for joining us, and I will see you in a webcast coming up soon. Bye for now.